there's been a lot going on the past few weeks. A lot of talk of a market bubble, whether we've hit the peak in the bull market. How concerned should investors be with this latest sell-off? Because a lot of strategists have also been telling us that a pullback was coming sooner than later.
Right. Well, a pullback would be normal, especially when you look at the energy that's been deployed coming off of those April lows. So some sort of a pullback in here would be natural. It's important, though, and the one thing that the markets have done very well all year is they might freak out a little bit in the short run, but they keep pulling back to what those fundamental threads, the underlying fundamentals are. And the underlying fundamentals remain pretty solid overarchingly. And we've seen that with tech company earnings, with other company earnings that were coming into the season so far, with something like 2/3 of the S&P having reported. We're talking double-digit bottom line earnings growth, which is pretty amazing for this far in the cycle. And so a pullback would be normal. The underlying fundamentals remain there. And actually a pullback, I think, would be constructive in here because it allows markets to reset. They had kind of run ahead of things, as markets are wont to do.
So you're saying underlying fundamentals remain strong.
The tape is twitchy, tech just took a hit, and everyone's asking, is this the end of the AI-led bull or just a reset? Watch how the guests frame concentration risk, debt-funded capex, and the K-shaped consumer. I'll cut through the noise and tell you what matters for positioning next.
How much can that offset the concentration risks within this market? Because we've seen the S&P hit 36 record highs, but just 6 stocks have driven half of those gains. So when you look at this pullback in relation to how concentrated this market is, does that indicate how much deeper the sell-off could potentially go?
Potentially, but you've also got, it's important to remember that those same companies are the ones driving the bulk of earnings and profitability. And you look at them in terms of, it's not like back in the late 90s. I know there's a lot of folks that want to conflate this with what happened in the late 90s, but it's a very different environment in terms of what's driven the earnings and driven the profitability are real companies generating real revenues out of real businesses. They're capacity constrained, which is part of why you've got the CapEx going on there. One of the things we are watching is how those are being funded, because you're seeing some of the funding happening in the debt markets now as opposed to cash flow. So yes, that concentration is there. But up until the past few weeks, we were seeing broadening out. There are other companies, other sectors that play into the build there, from in industrial manufacturing, materials. There are a number of different industries, too, that are generating double-digit earnings growth during this season.
Here's the real read. A pullback was overdue after April's surge, but the backdrop isn't 1999. Mega caps are printing real revenue and real cash flow. The risk isn't that earnings vanish, it's that multiples compress if AI spend gets funded more by debt than cash generation and the market questions durability. That's why the sell-off clustered around the same leaders that drove the advance. Second, breadth matters. We'd started to see rotation into industrials, materials, and select cyclicals. If that broadening resumes on weakness, it argues consolidation, not collapse. If it doesn't, downside can run until positioning and sentiment reset. Third, seasonality versus macro. November and December often help, but watch 3 catalysts. Labor data trend, is softness accelerating? The Fed's December tone, cut, pause, or higher for longer language? And earnings guidance on AIROI. If guidance shifts from spend at all costs to disciplined ROI, markets may reward free cash flow over headline growth. Finally, portfolio stance. Systematic rebalancing makes sense. Trim outsized winners, redeploy into quality at better prices, and keep dry powder for forced liquidations. Overseas value, Europe, can work as a diversifier, but insist on earnings follow-through and balance sheet strength.
Does that worry you that these Mag 7 players are now funding a lot of their debt or tapping into the bond market to fund a lot of these endeavors?
Yeah, it's definitely something worth watching, and it's worth unwinding, because in my own head, we're trying to figure out, do you get so intertwined? And I think we're very early in that process because they had very strong balance sheets. They're trying to lever responsibly, if you will. They had almost underutilized balance sheets in a lot of cases. But the one thing we want to make sure is that we don't have a concentrated list of companies and funders that become so intertwined that they all become too big to fail. That's one of the things we're watching pretty carefully as well.
This is the Cryptagon. Stay sharp, stay informed.